Okay, let's take a look at the exercises that are similar to your homework for the first assignment for Chapter 4. So this first problem, we have a company that starts a merchandising business in year 1, and they have the following transactions. So we're going to put those on the grid, and then we'll look at a quick financial statement. So number 1, she acquires 50,000 cash from issuing common stock. So cash is going to increase, common stock will increase. There's no impact on the income statement, and we have a positive cash flow that's a financing activity because it deals with transactions with the owner. Next transaction, she purchased inventory for $22,000 in cash. That's one of those asset exchange transactions. So cash goes down and inventory goes up by 22,000. That's our cost. And we have a cash outflow that's an operating activity of 22,000. Next, they sell inventory costing 18,000 for 28,000 cash. So 28,000 is the selling price to the customer, 18,000 is the company's cost of those products. So again, we have to do two transactions when we do a sale of products. So we could do them in either order. I do the sale first. So in this case here, we receive cash of 28,000, retained earnings goes up by 28,000, we recognize revenue, and we have a $28,000 cash inflow that's an operating activity. The second part of that entry is recognizing the cost side of things. So we always do two transactions when we sell products. So in this case, we're going to decrease our inventory because some of our inventory is left. We don't have as much now, so we decrease it. And we pull down retained earnings by recognizing an expense. There's no cash flow associated with that. We already paid for the inventory. So when I total things up, I see I've got 60,000 on this side of the equation, 60,000 here. I have net income of $10,000 and a $56,000 net change in cash. So the next thing they ask you for is I'm not going to do everything that problem asks you for, but a quick little income statement. So in this case, we have sales. That's what we call revenue when we're a merchandising company. So sales of 28,000, cost of goods sold of 18. So I've got a gross margin of $10,000, and I took it a step further and showed what the percentage was there. I think that's more interesting than the dollar amount for most companies. The next problem, 4-5B, says on March 6, year 1, Salon Express purchased merchandise from Hair Fashions with a list price of $19,000. Terms were $210 net $45. On March 10th, Salon returned merchandise to Hair Fashions. The list price of the returned merchandise was $8,500, and then they settled up on March 15th. So the question here is, what is the amount that they should pay on March 15th? Well, the first thing we need to do is take a look at what the real net purchase was. So the gross original purchase minus the return. So the purchase was $19,000. The return is $8,500. So the gross amount that's subject to the discount is $10,500. The discount percentage, again, if the terms are 210, that means take 2% or 0.02 if you pay within 10 days. So 2%. I get $210 as the discount. So the amount I'm going to pay is $10,500 minus 210, or $10,290 will be what I have to pay on March 15th. Now the next part of the problem asks you to do those same transactions on the grid here. So the first transaction, when we purchase the inventory, merchandise inventory goes up. We purchased it on account, so accounts payable is going to increase. When we returned $8,500 worth of stuff, inventory goes down because I'm taking stuff off the shelf and shipping it out. I have less inventory now, and I owe that supplier less money. I then recognize the discount, which lowers the cost of my inventory, and I reduce my accounts payable. And then lastly, I pay what I owe. So cash goes down by $10,290, accounts payable goes down by $10,290. I end up with 0 for accounts payable. I think the last part of the problem, nope, I think that's it. So hopefully that will help you with that assignment. So I will talk with you again when I review the second homework assignment for Chapter 4.